Along with my day job running an investment business, I started Tinsley Park Talks, a global networking and leadership platform where I interview industry legends from finance to tech and great thinkers to notable celebrities. In these interviews, we discuss great ideas around investing, entrepreneurship, problem solving, and all other lessons of life. Welcome to another episode of Tinsley Park Talks. This program is in partnership with Nesh. For more information, please click on the link below. If you're a student of corporate finance or an investment professional, you've heard of Aswath Damodaran. Known as the Dean of Valuation at New York University's Stern School of Business and author of numerous books, Professor Damodaran is the undisputed guru of finance. He's well respected worldwide and is often called into big media outlets to make sense of financial markets, the economy, and values of individual companies. I had an amazing opportunity to ask the professor himself his perspectives on these key things: valuation and the importance of storytelling behind the numbers, recent interest rate hikes, mounting inflation, and most importantly, how investors should find simplicity in valuation in a noisy world that's overloaded with data. Let's hear from the Dean of Valuation himself. Take a moment to please subscribe to the channel and like this video. We really appreciate your participation. Professor Damodaran, welcome to the show.
Oh, thank you for having me.
Professor, I've known about you for ever since I was in my undergrad in New York. I remember after I graduated college, I had a friend that worked at Merrill Lynch, and I told him, how do I get into investment banking? This is 2008, around January, February of 2008. I'm sure you recall. Around that time, he said, you must get Professor Damodaran's book on valuation. So I've had it since 2008, and it's traveled with me and everywhere I've lived since then. So thank you so much for taking the time, and you have a very busy schedule. I want to start with your roots. You grew up in India. Tell us about your upbringing in India.
Yes, I have nothing to complain about. It was a life that was full in many ways. Might have lacked in some of the technology and other things that people draw on. But I grew up with an extended family, which used to be the rule rather than the exception in India because people didn't move very far. My extended family stretched all across the city that I lived in, then called Madras, now it's called Chennai. So there might not have been TV, and you might have listened to the radio once in a while, but we lived on social interaction. Families gathered together and they talked and they chatted and they argued. So that's the environment I grew up in. And, every person is a product of their upbringing and all their experiences, and I'm a product of mine.
What led you to choose the United States, and how did you end up at UCLA?
At that time, the only way that you were able to move up through education in India was once you hit a ceiling. It wasn't, if you were an engineer, you had to go abroad. And probably until the 60s, that used to be the UK, the old colonial connection was still there. But starting in the late 60s, you start to see Indians come to the US. The first wave were doctors. The second wave was economics and business students. So I was among the early waves of business students. And that's, so it was the US, and how I picked UCLA was pure chance. At that time, remember, there was no online site you could go look at schools. There was no Business Week ranking. So I walked into the US Information Service Library in Chennai, and they had catalogs from different universities. I had no idea where the universities were, what they did, what their reputations were, other than perhaps a few Ivies and perhaps Stanford. And I picked up the catalog for UCLA, and it looked sunny and very attractive. So I said, you know what, that's where I'm going.
So you get to UCLA, and I heard you speak in one of your interviews in the past that you haven't watched a lot of TV in India because TV, frankly, didn't really get commercialized
right
at the time you left India. And then the first thing, or one of the first things you see is, what do you see? Do you want to share? That was very funny.
It wasn't that TV hadn't come to India. TV came to Mumbai first, but Chennai always was last on the list of getting things. And we didn't get TV till the late 70s. And the TV we got was 3 hours in the evening. And I think 1 hour of that was reruns of the I Love Lucy show because they got it for free. So I had grown up without TV, and you land in LA in 1979, talk about a cultural shock. You leave perhaps the most conservative city in India, a conservative city, the most conservative city in what was then a very conservative country in terms of tradition and things being done the way they were. And you land in LA, which is at the exact opposite end of the spectrum. There's no tradition holding the city together. Anything goes. And it was quite a shock. I enjoyed it. I was young enough that the shock didn't throw me off, but it was really different. It was different on every single dimension, but I was ready for different.
So the second wave of those business students from India, you started UCLA doing your MBA, which is a usual track to go into consulting or banking at the time, especially that time it was early 80s. You decided
the start of the banking boom. It was mostly consulting when I entered. By the time I left in 81, that was really the start of the huge investment banking boom. I mean, until then, your premier job at a business school was a consulting firm. Right. But 81 was when the investment banks all decided they were going to go big time into investment banking, lots of hiring. And that's where I was headed because I entered my MBA in 1979, in the middle of perhaps the worst recession the U.S. has seen in the last century. It's the Paul Volcker years. Correct. So it's actually an experience that I think was good in hindsight because I came into the market at a time when inflation was a clear and present danger. So I never had to ask what will high inflation look like. But in 81, I was heading into an investment banking career and moving on when I ended up being a TA for an accounting class, a subject I don't even like because I needed the money. And right. I walked into the class and about 15 minutes in, I said, you know what? This is what I want to do with the rest of my life, be a teacher. I mean, I tell people you get God shots, all the time. Right. We ignore them most of the time. That moment of recognition that this is what I was meant to do. We're so busy with our lives, we don't even notice it. I was lucky enough, with pure luck, that I noticed that this was what I wanted to do. And right after the class ended, I went up to the finance department and said, I'd like to be in the PhD program. At that time, getting into a PhD program was much easier. So they said, okay. And I went on to finish my PhD at UCLA. I taught at UC Berkeley for a couple of years towards the end of my doctoral thesis, and then came to NYU in 1986.
So when you arrive at NYU, the administration at the college asked you to teach a class that Ben Graham has influenced, the securities class. Right?
Every business school had it. It was called security analysis. It was a carryover from the Ben Graham days at Columbia. It was basically, but as the title says, it was analyzing any kind of security, stocks, bonds, options, futures. So there's a little bit of this, a little bit of that. When Ben Graham started, security analysis was just stocks. And then you had fixed income, and then you had, options and futures and derivatives. So it had become a collection of topics with nothing really holding them together other than the fact they're all securities. So I don't like teaching classes where there's nothing holding the class together. A collection of topics has never appealed to me. And that was part of the reason I went to the head of my department and said, look, I'd like to teach a valuation class because I think I can create a narrative around it. And at that time, he said, don't do it. There isn't enough stuff in valuation to teach a class. He was absolutely right. In 1986, there wasn't, but I taught it anyway because I wanted to do it. But I think that at that time, there was, when I did my MBA, I think I tell people we spent 2 hours out of 2 years actually valuing a stock. It was a stable growth dividend discount model, and that's about it. Because that's all valuation was in school curriculum. So it was a hard grind that those, if you look at my books, they all started as lecture notes in my class. I've never sat down to write a book. My lecture notes get thicker, and at some point, say, look, this is 800 pages of lecture notes. It's, it's time to turn it into a book. So it's the class gave birth to the book. The book then feeds back into the class. I couldn't tell you where my class ends and where my books begin and where my blog begins. They all kind of swim together in the same pool.
Did you know that your company's most valuable assets are the knowledge stored in your experts' minds and the content they've created over the years? These assets form the foundation of successful teams. When experts go on vacation, move teams, go on parental leave, retire, or resign, your teams find themselves in the dark, resulting in onboarding delays, quality loss, burnout, and drop in customer satisfaction. Nesh revolutionizes this for you. Nesh turns subject matter expertise into subject matter avatars to preserve this knowledge. Nesh connects all of your company's content, turning treasure troves of data and knowledge from your experts' minds into precise, searchable answers. Nesh is made for simplicity, where you can ask a question in natural language. It's just like interacting with a colleague. She improves continuously to become the ultimate subject matter expert for your organization. With Nesh, use your knowledge as a superpower to bring innovative products to market, grow business blazingly fast, and provide an extraordinary experience to customers. Unleash the power of your enterprise's most valuable asset with 24/7 available subject matter avatars.
Yeah, that all sounds very organic in the way it all happened. And if somebody asks me, somebody asked me, what kind of professor do I think you are? Not that I've taken your class, but just knowing of you, I would say you're a disruptor, just purely from this story of saying, no, I don't want to teach this class, even though it was one of your second very early jobs at NYU, right? And you went to the dean or the head of the department, you said no, and you got a new class where there weren't a lot of other benchmarks to go after. So you kind of created it itself. If I were to ask you, what's your teaching style? What would you say it is?
I tell people, look, I'd rather be transparently wrong than opaquely right. And my teaching basically reflects that, which is I'm not afraid to take a stand. I mean, I valued Tesla 3 weeks ago. I valued the Adani Group 2 weeks ago. I mean, basically companies in the news. I don't believe in this antiseptic, pick a case from 25 years ago where you know exactly what happened, make it look like you did not, then come up with a valuation that it would have shown, makes you look like a hero because you say, I could have told Time Warner in 97 not to buy AOL. Right. Now, I've never used a case study in my class. I have 45,000 live case studies around me. And my teaching is about being in the moment, teaching about things that are happening in real time. And I'm lucky enough to teach classes that are very much part of the real-time discourse, corporate finance and valuation. You're surrounded by things happening that are fodder for your class. So because of that, my teaching is essentially, it's almost, I don't think of it as academic. It's basically, how would I value a company? And the company is right here in front of you. And the advantage of valuing a company in real time is you don't know how the story is going to end, which I think is exciting. A lot of teachers find that troublesome because they want to control the script till the end. I'm willing to lose control of the script because I think people enjoy watching real lab experiments happen. Sometimes I'm right, sometimes I'm wrong. And that's part of teaching too. That's what I mean about being transparently wrong, is when I'm wrong, people can see exactly what dimension, what input that I had that was wrong because it's all there. I put out my story in my Excel spreadsheet so people can see exactly what I've estimated. So nobody is looking for what did he get wrong. They know exactly what I got wrong, which some people view as a problem. But for me, it's part of teaching.
I enjoy learning, watching your videos. I haven't been in one. Maybe one day I'll be in one of your classes if it's meant to be. But so you're the Dean of Valuation, as they call you. If you talk about valuation, you can look at valuation, purely by numbers. But then, is that really effective? You talk about storytelling being probably the most important thing behind valuation. So if I were to ask you, what is valuation? Is it a science? Is it an art? What is it? Why is it neither?
Yeah. Science requires precision. The way I think about a science is math is science. 3 + 2 is 5. Count on left hand, right hand, computer, calculator, North Pole, South Pole. It's absolute. You get it right or you get it wrong. So in science, if you get the inputs right, you get the output right. Physics is mostly a science. But if the essence of a science, if you get the inputs right, you're going to get the output right. Valuation can never be a science. Why? Because you can get every single input right, given all the information you have in every model out there, and you're going to be wrong 100% of the time. Why? Because you're not God. I mean, if you valued a hotel company in late 2019, I don't care how much data you brought and how well you thought it through. What you could not or did not foresee was 5 months later, every hotel on the face of the earth would be shut down by COVID. Those are the things you don't control. And there are hundreds of things like that that you don't control. So when you do valuation, you have to accept the fact that you can do everything right and there's zero chance that you're going to get the value right. You're just going to get your estimate of value, and then fate will play a role and the world will decide where it goes. So valuation is not a science, and the sooner we accept that, the healthier the discussion becomes. Because I think a lot of the most unhealthy developments in valuation come about when people think they can make it a science. You see it with accounting rule writers by writing more rules. You see it in legal settings. Is your valuation right?
You love
There's
accountants, right?
Why.
They're one of your favorite professions. Accountants. You love them, right?
Absolutely. I love them. Without them, I can't survive, right? They give me my raw data. But I think that that both in accounting and legal settings, there is this sense of you're going to get a precise answer. You must have done things right. So it's not a science. It's not an art either, because the people who say that want to do whatever they want. That's what they mean by valuation is an art. I'll do whatever I want. You can't do whatever you want. It's a craft. And the reason I draw the distinction between craft and an art is if you started cooking and you said, I'm going to make an art and throw whatever I want into a dish, you can do it, but you can't eat that dish.
Right.
There's a craft to cooking. There are things that go together. Garlic and onions go together.
Yeah.
Garlics and sugar, not so well. So when you talk about a craft, basically you work at it. You don't start off as a master of your craft. You've got to do it. You got to make mistakes. You learn from your craft, and over time you get better at the craft. Valuation is very much the same. People think they can learn valuation by reading books or watching other people do valuations. No, you might learn a little bit of it, but ultimately you've got to actually value companies. Struggle through your first few valuations, just like you'd have struggled when you first learned cooking. But eventually, if you're willing to learn, you will get better at the craft. You will never master it. That's why when somebody says, I have mastered valuation, you already know that they really don't understand valuation. You can get better at each aspect of it, but you will never master it.
Understood. In a world of so much data, we have AI, we have these we have these massive Excel spreadsheets and the news and geopolitics. In a world that we live in today, how do you, as professor, the Dean of Valuation, value a company in a simplistic way? A company, let's say like Tesla today, if you were to value it, not in the most intrinsic and detailed manner, but if you were to talk about it in a linear fashion, what are some of the simple ways you'd value a company in this noisy world that we live in?
Before I actually talk about valuing a Tesla, I mean, the key, the reality that you're pointing to is we can no longer complain that we don't have enough information or data. We have too much. We're drowning in it. And I tell people, look, the worst thing you can do when you want to value a company is to go into Google search and type in the name of the company. Because you're going to get thousands of hits. I mean, you type in Tesla, think of the thousands of hits you're going to get. It's actually going to make your life more difficult, pulling up all the data, trying to read it. So I tell people first, your search has to be focused. You need to know what you're looking for before you go looking for it. So what my valuation framework is designed to do is say, okay, what are the things that I need to value a company, whether it's Tesla or whether it's Airbnb or whether it's Coca-Cola? I need to be able to project their growth. I need to be able to project how profitable they will get over time. And they need to project how much they will need to reinvest to get that growth. Fundamentally, those are the three big questions that drive value. There's a risk part, but the risk part, I think we spend too much time on. It's not where valuations are made or broken. So you're looking for information that will help you forecast the growth of a company better. Now, with a company like Tesla, that's more difficult than a company like Coca-Cola. Coca-Cola, I mean, estimating the growth in the beverage business is relatively easy. It's a mature business. It's the largest player. You're not going to get 50% growth a year. With Tesla, you have a twofold problem. The first is that the market it's going after is itself evolving. It's the automobile market, but a greater percentage of it is going to electric cars than it used to. So the first judgment call you're trying to make is, hey, what percentage of the cars bought on the face of the earth will be electric cars? So already you have a layer of uncertainty. Second, everybody's producing an electric car. If you noticed, every traditional automaker has got electric cars. You got these new car makers, the Neos, the Teslas, the Lucids, Nicolas, all producing electric cars. You're saying, who's going to dominate this market? I mean, when I talk about how valuations are driven by stories, you take a company like Tesla, your valuation is going to be animated by the story you tell about Tesla. So the story you could tell is so think about the most optimistic story you can tell is that every car sold by 10 years from now will be an electric car, and Tesla will have a dominant market share. And you got to have a reasoning for that. They were first to the market, their batteries are better, their charging might get proprietary. But if you tell that story, the potential revenues you're going to get as a result of that story will be much larger. You can have a $600 billion company, maybe even an $800 billion company if it becomes the dominant electric car company. So when we talk about growth, we think about a growth rate, but I would suggest you think about a vision of what your company will be, because that vision will tell you what revenues you can have, and those revenues will tell you what growth rate you can afford to use. But that's only half the story. You can grow your revenues, but you won't become valuable unless you can make money off those revenues, your margins. And Tesla, if you start the process off as an automaker, starts off at a disadvantage. Why? Automakers can't make high margins. It's not because they're not efficient or because they're badly run, but because it costs you money to make a car, as opposed to software, where the extra unit of software Microsoft costs you nothing. So it's pure gravy. Software companies can have 35, 40% margins. Even the very best manufacturing companies struggle to get to double-digit margins. Right. And here's the problem. With Tesla, even with huge revenues, if they remain an automobile company in terms of margins, there's zero chance you can even get close to their existing value, existing market cap. So the second part of your story is, hey, will Tesla find a way to change this business and deliver much higher margins? And you got to give the company credit. This is a company that seems already to have found a conduit. People question whether it's permanent, of earning 18, 19% margins in the last couple of years, much higher than the margins of a typical automobile company. And the reason for that might be simple. An electric car might be more iPhone than automobile. Right. If you think about the iPhone, Apple makes, they sell the iPhone to you for about $1,000. It costs them less than $200 to make the iPhone. Electronic devices. So the story you have to tell about Tesla to get the numbers that you would to have to drive the value will be a story of an automobile company with a technology component, either software or something that drives your margins up. And it's able to do all of this incredibly efficiently. As the traditional automobile company, to make more cars, had to build huge assembly plants. Right. If Tesla has to build enough assembly plants to make 60 million cars, and they spend like the old automobile companies, they'll spend themselves into the ground. So the third piece of the story is, has Tesla changed the manufacturing part of the automobile business enough that it can get away with reinvesting less? And here again, there are positive signs, right? Remember, they made cars out of tents in 2019. And they've also, their automobile, lines have more robots in them. In fact, they're trying to develop their own robots, the Tesla bot to go on. So with Tesla, there is a plausible story you can tell, which will give you high revenues. When I say high revenues, The revenues you'd need would be larger than the largest company. Though right now, Walmart is the largest revenues in the world. Tesla would have to have more revenues than a Walmart, have margins like a big technology company, and be able to reinvest like no automobile company has been able to reinvest in the past. It's already an exceptional story. And with that exceptional story, the value that I got, and this is about a year and a half ago before my most recent valuation, this is when they hit a $1.2 trillion value. With this exceptional story, the value I got was about half of that 1.2 trillion. So the way I read my valuation is, look, I'm not going to tell other people to buy or sell Tesla. That's not my job. Right. If you want to buy Tesla, go ahead. But do so with open eyes. That you're buying a company that you've already valued to be the greatest company to ever walk the face of the earth. And here's the problem. When you do that upfront, you pay the price. It'll be the equivalent of my taking Jason Dominguez. He's this young kid that the Yankees have, who's like 19 years old. He looks like he has a lot of power. And paying him $100 million a year for the next 15 years because he's going to be not just the next Mickey Mantle, but the next Mickey Mantle and the Aaron Judge rolled into one.
Right.
If you do that upfront, where's your upside, right? If he turns out to be as great as expected, you paid full price upfront. If he just turns out to be really, really good, or even just a great player, it's going to be a disappointment. You can't price companies for perfection or this exceptional story, because then you leave no upside for yourself. You've essentially given away the store up front. So when I think about valuation, I don't think about sitting there with a spreadsheet saying, let me make up numbers. I think about the company, I think about the business, and I craft a story. I don't claim to have a monopoly on the story. So I leave the storyboard open saying, this is my story, my numbers, my value drives my decision. But you know what? I'm not going to ask you to make your, in fact, I encourage people not to base their investments on my decision. I say, look, it's an open spreadsheet. You see my story, go and change it. Don't bitch and moan that you don't like the growth rate, that you think the story is too big. It's my story. It'll drive my decisions. You got to find your own story and make your decision be driven by your story. I mean, we need, as investors, I think we all need to take ownership of our decisions. What I mean by that is I often see investors say, why do you buy that stock? Jim Cramer told me to do it. Goldman Sachs put out an equity research report. It's your money. Jim Cramer is not responsible for your money.
Right.
We need to stop blaming the rest of the world and take ownership of our decisions. Do people give bad advice? Absolutely. But you don't have to take the bad advice. It'd be the equivalent of me going to a television store, coming back with a 75-inch plasma TV for a tiny studio apartment in New York and not being able to get the TV into my apartment. I can get really mad saying, how dare that guy sell me a 75-inch TV? But guess what? It's your studio apartment. You asked the guy, what's the best TV for me? He gave you the one that he got the biggest commission on. He was acting in self-interest. It's not his fault that you took his advice. So I think when I think about valuations, I think about creating a framework, telling a story, but then saying, look, it's my story, my valuation, make it your story and your valuation and drive your decisions.
There's an example of that in your real life. I recall Bill Gurley had said something after you had given your opinion on Uber. This is before it went public many years ago. And Bill Gurley, if people don't know who he is, one of the partners at Benchmark Capital, a VC fund.
One of the premier VCs, one is the deepest thinking VCs. Deep thinking VC is an oxymoron usually, because VCs are not deep thinkers, but he is a deep thinking VC.
So how did you reconcile with him when he came and said, no, it's not what you think it's valued. It's a lot higher.
This is the thing, that a debate is never a debate about valuation. It's about some aspect of the story. And I encourage people to do that, because if you make it about the bottom line, then it becomes is your growth rate better than mine? We're telling different stories. And I'll tell you the core of what I did. This was my Uber 2013 valuation, where I admitted in hindsight that I screwed up. At the time I valued Uber, it was its starting point, a young ride-sharing company, and I had to decide how big the total market was for it. And I made the mistake of saying it's a car service company. There's a car service market out there, taxi cabs and limo services occupied. I got the market size done pretty well. It was 100 billion. And Bill's point was, hey, you're missing the fact that Uber is changing behavior, that people who wouldn't have taken car service will take car service. There are a few people who stop buying cars and take Uber instead. And I said, you're right. Because that actually has tripled the size of the car service market, because ride-sharing companies have changed behavior on the part of people. In much of the Bay Area now, people don't even own their cars because it's so convenient to rely on Uber and Lyft to get wherever you want. You don't have to pay insurance, there's no parking, you don't have to worry about theft, and they're all 2 minutes away. So what I missed in my original Uber valuation that Bill pointed out to was, he said, look, you're getting the total market wrong because you're missing the fact that these companies can change the total market. And he's absolutely right. You know why that story won't work with the Tesla, right? You can't take 90 million cars and make them 900 million cars because there aren't enough roads to put it in.
Right.
But something like car service, you can change the business. So when I valued Airbnb 7 years later, I took that to heart, because rather than take the hotel business, which had revenues of 660 billion, and make it my target, I allowed for the fact that Airbnb would change the way we travel and made the business twice as big, saying I learned from my Uber. And that's all you can do, is when you screw up, you say, you know what, you're right. There's nothing you can do in hindsight to go back and fix. In fact, it's pointless to go back and fix a valuation 2 years ago. Just stop. Stop doing something that doesn't make sense anymore. So I've learned. On one dimension, though, I think I was on the right side of the debate, which is I argued that these margins that all these technology companies, because all of these companies are built on what I call a field of dreams model, which is if we build it, they will come. In other words, get the users, get the revenues, and the profits will come. And I said, that's not that easy. You got to work on a business model. Business models don't form themselves. And if there's one critique I would have of all of Silicon Valley's companies in the last decade, is they got so focused on building up users and subscribers and revenues that they forgot how to build a business model. I remember in 2019, Dara Khosrowsky, CEO of Uber, finally saying, you know what, at Uber, we need to figure out how to make money. And I got down on my knees and said, thank you, God. Finally, somebody is saying, hey, you need to make money. But it's almost like that became an afterthought. And 2022 was a reminder that profits were not some passing 20th century phenomenon, that every business eventually has to make profits, no matter how much potential it has. And you got to work on building a business model. It doesn't happen automatically. In fact, one of my worries with these companies that scale up so quickly, the ride sharing did it, Airbnb did it, is one of the prices you pay when you build a model built on scaling up quickly is you're also building a model which is not sticky. What I mean by not sticky is I'm an Uber customer, but I've Lyft on my phone. You know which one I pick?
Cheaper.
Always the cheapest one. Yeah. I've no loyalty to either. And the guy who's driving me has Uber and Lyft stickers usually on his car. Guess which one he drives for? Whichever one calls. You cannot build a company on a business model without stickiness. But the problem is, putting stickiness in often means giving up on scaling, because the kinds of things you got to work to make your business model sticky are often things that will prevent you to go from 20 cities to 400 cities, which Uber did over a period of 3 or 4 or 5 years. So I think we need to rediscover the criticality of business models and how to work on them, because a lot of Silicon Valley seem to have completely lost touch with that aspect of business.
Take a moment to please subscribe to the channel and like this video. We really appreciate your participation.
Mm-hmm. Mm-hmm. I want to talk about the current interest rate and inflation environment that we're in. But before that, I want to ask you, how would you value a younger company? Let's say if you're a VC investor now looking at a Series A type investment, how would you value them?
Yeah.
Or Or price them. I know that you differentiate pricing and valuation, which is fair.
Right. The pricing part is easy, right? You basically look at what other people are paying for similar companies and you scale it to a metric. Price per user, price per subscriber, price per download, price per employee. Remember, now the .com companies, and this is not new, it's been around as long as time. I think when somebody says, look, I'm having trouble doing valuation, the question I always ask them is, what is it that's giving you trouble? So when you think about valuing these really young companies, I say, what is it that's giving you trouble? And if you isolate it, it's not that they're young, it's not that they're high tech. What's giving you trouble is you don't have that crutch of past history. Let's face it, when you value companies, it's nice to have a lot of history because you can learn from history, right? So you value Coca-Cola, you have 100 years of history. You know their business model. You know what a good year looks like. You know what a bad year looks like. And for better or worse, it gives you a crutch because when you make your estimates, you can say, I based it on the average for the last 10 years. So here's the first thing I'm doing. I'm taking that crutch away. So you don't have the crutch of past data. The second crutch you look at is business model. You take the existing numbers. What's the gross margin? What's the operating margin? You're trying to get a sense of the existing business model. With a very young company that's still working on a business model, you can look at the current financials till the cows come home, but you're learning very little about the business because there's not much there. So you don't have history. You don't have a business model in place. And if every other company looks just like your company, they're all at the same stage, you've got the trifecta. You got no history, no financials that you can use, and you can't base it on other companies further down the life cycle. Because they're all, all the ride-sharing companies pretty much hit the market at the same time, right? Uber, Lyft, Grab, Didi, they're all young companies. They're all money losing. They all have a business. So you don't have any crutches. And you know what? That makes us uncomfortable. So what's giving you trouble in valuation is you've gotten so used to having those crutches that once I take them away, you say, what do I do? Hey, do you face the same task that I did with Tesla? Absolutely. Ultimately, with Tesla, the past crutches weren't what drove my valuation. It was my perception of what will happen to the market, how big a player Tesla will be. You'd have to do the same thing. You have to rely more on your imagination. You have to rely more on looking at the overall market. You have to rely more on your story. Now, evaluation is a balance between stories and numbers. With a company like Coca-Cola, you might be able to get away without a story. The numbers pretty much, and the way I describe it's like being in chapter 34 of a book. It's a 35 chapter book. You know what's coming. Mm-hmm. You've got 33 chapters behind you. Valuing a young company, it's like being on page 3 of a 350 or a 3,500 page book.
Right.
I think it's exciting because it means a whole story is ahead of you, but it's also scary. You're saying, how do I know that I got the right story? And here's my answer. You don't. And nobody does. You're not special. Everybody who looks at this company, including the people running the company, are completely in the dark about what the future will deliver. The way I judge valuation is not by how precise your valuation is. Because a valuation of Coca-Cola will always be more precise than a valuation of Lyft. But how precise your valuation is relative to other people valuing the same company. Anybody can value Coca-Cola precisely because it's driven by numbers. Most people don't even try to value young companies. VCs don't even try. They give up. They use this word. There's too much uncertainty. You can't hide behind that word. The reality is the minute you buy shares in one of these companies, you are making implicit assumptions about the future, whether you like it or not. And I do valuation. I say, why would I want to leave that implicit? I might as well make it explicit. Because if I don't make it explicit, how the heck will I ever know whether I'm even on a pathway that I need to be on to make my money back?
Understood. Professor, as we're seeing rates going up to fight inflation, how do you think about the risk-free rate going forward?
All driven by inflation, right? Inflation has been the drive for the last year and a half. It's kind of taken over the entire stage. And that's always the problem with inflation. Inflation comes on the stage and you have a play. It's taking every line. Every scene, it's a scene.
Everything. Yeah.
It basically sucks up everything else. And in the last year and 3 months, it is the only topic that's driving markets. So when people talk about the Fed, it's not the Fed that's driving markets, it's the inflation driving the Fed. When people talk about the economy, it's what inflation will do to the economy. Inflation is and this is always the case. And this is why in early 2021, when inflation was first starting to show its head, I said, my advice to the Fed was act like it's here, act like it's permanent, even though it might be transitory, and take your actions now. Because once it gets out of the box, it's like a genie. It's out of the bottle. You're not going to get it back in there. As we're discovering, right? Inflation is down, it's back again. Inflation is incredibly stubborn because a great deal of it is psychological, right? You live with inflation for, even in 15 months, people have gotten used to kind of bringing inflation into their decisions. You go ask your boss for a pay increase, you say, I want at least a 7% increase. You know why? Because in your head, that inflation is already started. And that's the cycle that's so difficult to break. And the longer inflation hangs around, the more difficult it becomes to break that psychological cycle. You know how Paul Volcker eventually had to do it, right? Eventually,
raise it like
only way to
crazy.
do it is to put you into the equivalent of not just a recession, but a really deep recession, where you don't even dare ask your boss for an increase. That's the way they make you stop. Is essentially they scare you so much by saying you won't have a job if you
Where
do
did
that.
it go up to? Was it like 17% at one point? Is it that high?
Well, short-term rates went up to 17 because inflation was 12, 13, 14%. The T-bond rate was at 14. That wasn't the Fed's doing. The Fed actually never raised the Fed funds rate. And that's the reason people are looking at the wrong thing.
Got it. Yeah.
You'd see the Fed funds rate go up. The Fed funds rate is not pushing up interest rates. Inflation is pushing up both. It's the driver behind the Fed raising rates. Right. It's also, so you're going to get the spurious correlation between rates and the Fed funds rate. And you're going to jump to the conclusion the Fed must be raising rates. I tell people to play a game. I say, let's assume there were no Fed, no central bank. What do you think rates would have done in 2022? I'll wager that rates would have gone up as much as they did with or without the Fed because inflation went up.
Interesting. That's an interesting distinction between the Fed's fund rate and that's a T-bill. Is that the short-term one that we always?
That's the short-term portion of the Treasury. Yeah.
Got it. So as a result of what's going on, how do you see risk premiums reflecting in return on capital overall?
We've come off a decade where we've been spoiled. We've been spoiled by risk-free rates being low and risk capital being so easy and accessible that anybody could raise capital. You could be a money-losing company, terrible business model, no problem. I think rather than think of 2022 as the unusual year, maybe we need to start thinking about 2010 through 2021 as the unusual decade. I think what you're getting is a reverse. So when I hear people saying, oh my God, what are we going to do with mortgage rates of 6.5%? My reaction is that used to be the norm pre-2008. T-bond rate right now is 4%. That would have been a low T-bond rate in 2007. It was 4.5%. So in many ways, I think this is healthy. I don't think it's healthy to have risk capital be so open and accessible because you get some really crappy businesses being fed billions of dollars of capital. And they can ruin other businesses while they have access to capital. So I think it's, it might be just a reversion back to a more normal time, but that doesn't mean it's not going to be painful.
So I remember in one of your talks, you talked about interest rates going up does not always necessarily mean that it's a bad thing, because sometimes interest rates go up because the economy is doing really well. I mean,
it's not sometimes. I mean, I've never seen a healthy economy with lower negative rates.
Right.
Never. So to me, the rates reflect the fact that if you're in a deflationary economy with terrible real growth, you're going to get really low. Japan's had really low rates for the last 30 years, since the 1990s. Think of the Japanese economy.
Not last decade anymore.
Last 3 decades, but there's a reason, right? Japan is an aging economy. Your real growth is going to be negative going forward, and the interest rates reflect it. Be careful what you wish for. See, please God, let rates go low again. Do you really want to be in a deflationary economy with negative real growth? I don't.
Right.
So I think it's healthy for rates to go up. But during that period of going from low to high rates, guess what? There's going to be pain. There are going to be companies that are unable to make their debt payments because their interest payments jump suddenly. So sudden transitions are never easy. And the speed with which rates climbed last year, I think I was surprised that the economy actually held up as well as it did, and the market held up as well as it did. This is a market that was down 18%. But the way rates climbed last year, I think it should be down at least 30%. So in a sense, I think it was a shock to the system. The system was resilient. It did much better than I expected. I don't think we can take another year with an equivalent increase. If you go from 4 to 7, then I think you're really stretching the limits of what's happening here. But I think you settle around 4, we'll find a way to live with 4%, but there might have to be some adjustment during that period. From the old days of 5% cost of capital to the new days of 10% cost of capital, which was more again the norm before 2008.
Professor, do you think we can continue on this kind of path as the most powerful economy in the world and having the reserve currency, being the reserve currency of the world when the reserve currency is under threat? How long do you think we can continue to do that? And I want to parlay that question with maybe briefly, what's your position on Bitcoin, which kind of,
everything has its day. The US had a great century. It's still the largest economy. It's still probably the most dynamic large economy in terms of creating new businesses, new technologies. So I think it has strengths that would keep it going. Frankly, I think this reserve currency thing is overblown. I frankly don't care whether you make but I don't see an obvious replacement currency for the dollar. For a while, it looked like the Chinese might, but the Chinese at this point, nobody wants to adopt the Chinese renminbi as your global currency. The euro is kind of stagnant in the water, so I think almost by default, people go back to the dollar because you see no obvious choice. Of course, crypto people say, what about Bitcoin? Now, come on, you've got the most inefficiently designed currency of all time, a currency that, it's built on no trust. There's a reason we build trust into systems. It makes things smoother, right? If you walked into a store and you didn't trust any of the items, you said, you tell me this is a radio. How do I know it's a radio? Take it apart. Commerce would come to a complete stop if we didn't have trust in each other. Bitcoin is built on the premise you can't trust anyone. That's why when you have a transaction, you got to have 1,000 Ukrainian miners checking to see whether you have enough Bitcoin in your wallet to pay for the transaction. When you build something on no trust, it's an inefficient system. Bitcoin at its core is just an inefficient currency. So I'm not saying you can't have a cryptocurrency, but it can't be designed like Bitcoin because it's not designed to be a currency that can be a global currency.
But isn't trust in the hand of the people? I mean, if you look at history, you could have trusted
but you design systems, right? Here, you got to
which takes time.
But remember, this is what I mean by trust. When you go into a store and you pay $20 and the storekeeper hands you back change of $8. Is there trust in this transaction? It's paper, right?
Right.
You're trusting that this is real money. I mean, I don't go around with a counterfeit money checker because it'll be insanely inefficient if every time you paid, you had. Imagine if whenever you use a credit card, you did not trust that machine to transmit it because somebody might steal it. You'd probably never be able to get a transaction done. So systems, I'm talking about the systems being built around trust, is what allows for commerce, what allows for efficient transactions. Does it mean there isn't some violation of the trust? Obviously, some guy is going to pass a fake $20 bill, and because you didn't have your counterfeit thing, you're going to be trapped. But you cannot have that be the rule. And in countries where fiat currencies have lost trust, remember, it's not fiat versus crypto, just trust.
Right.
And imagine being in the Venezuela, the Venezuelan bolivar, nobody wants to hold you. Why? Because they don't trust the currency. Trust is at the heart of smooth commerce.
Right.
It smooths out commerce. And to the degree that you build a system, and this is what I mean, the Bitcoin system is built around trusting no one, no central bank. Why?
Right.
Because they might learn things about you. So I think that that's what I mean about the absence of trust driving it. And because of that absence of trust, it's a very inefficient crypto. Could there be a more efficient crypto? Absolutely. Could it replace fiat currencies? Yes, but you'd probably have to get buy-in from governments. Why? Because you got to collect taxes. You can't have a currency where nobody can trace your transactions, because we'd all collapse. Right? You might say, look, I don't want to pay taxes, but if nobody pays taxes because they're using currencies that cannot be traced, how do you keep a society going? So I think it's going to be a crypto with buy-in from governments and central banks. It's going to be, but you're already there, right? When was the last time you actually pulled currency out of your pocket? We're already at Apple Pay. What difference does it make with an Apple Pay, whether you're paying in dollars or euros or some cryptocurrency? It basically is a transaction. So I think we're already there in terms of digital access. I don't know whether having a cryptocurrency is going to change anything in the way we interact and pay for things.
Do you have an investment philosophy?
Yeah, if I find something undervalued at the right price, I will buy anything. At the wrong price, I'll buy nothing. To me, there's this notion that you buy good companies, you avoid bad companies. I don't get that. As an investor, if you have a bad company that's being priced as an abysmal company, in fact, a little matrix that I drew in one of my posts, where I had on one dimension had companies going from excellent or exceptional all the way down to abysmal. And on the other axis, I had the same, exceptional to abysmal. So I said, if you buy an exceptional company and you pay the price for an exceptional company, you're going to get fair value. You're basically going to make a fair rate of return. If you buy an exceptional company and it turns out to be only very good, you're going to lose money. So that's my argument for Tesla being priced as. But if you have an abysmal company that's been priced as a very bad company, it's actually a good investment because they've, so with each one, you're looking for a mismatch. So I think that's a way to think about investing. And that's my core philosophy is I will buy anything. Yeah, growth, mature. I don't restrict myself to some stages of the life cycle, some geographies, or even, what kind of sectors I invest in. I hop around. I'm a dabbler. I buy infrastructure companies. I buy technology companies. I buy, Indian companies. I buy Brazilian companies. To me, it doesn't matter if I get it at the right price.
I remember you talked about Petrobras in one of your talks and how they're not the greatest example of how they report their financials and what they do with their projects. Professor, we're running out of time, but what advice do you have for entrepreneurs? I heard you talk once about humility being probably the most important quality to be a successful investor. Do you still feel the same way? Are there anything else that you want to add?
Are you talking about entrepreneurs or investors?
Investors.
Entrepreneurs, it's different, right? Investors.
Okay. Well, let's talk about both. What advice do you have for investors and what advice do you have for entrepreneurs?
Investors, own your mistakes. Be willing to be creative, imaginative, and be consistent. Have a well thought through way of saying, this is what I think about markets. These are the strategies. That's what a philosophy is. Don't try to be Warren Buffett or Peter Lynch. You're not. You have a very different personality. The best investment philosophy is the one that best fits you. There's no one best investment philosophy. So I think investors need to know themselves first before they become investors. What makes you tick? What makes you unhappy? What makes you uncomfortable? And then try to craft a philosophy that reflects who you are as a person. For entrepreneurs, my advice is, you need to learn how to build businesses. Too many entrepreneurs now are great ideas. They've got amazing apps. They got lots of capital. They know how to grow their users, all great things. But you need the basics of business, right? Building a business model is hard work. It's grunt work. And a lot of entrepreneurs find it boring. Supply chains. Who wants to sit in on it? But without supply chains, your great idea is going to crash and burn because it'll never get to the market. So I think for entrepreneurs, my advice is learn the mechanics of business. Learn how to build a business model, because that's what's going to make the difference between having a great product and a great business.
Great advice. And so what makes Professor Damodaran happy?
Put things away at the end of the day and not have to think about them. So I don't think about stocks and markets, and it's not, no, your happiness comes from your family, your friends, your children, your grandchildren, the people around you. It doesn't come from how well your portfolio is doing. And if it's coming from how well your portfolio is doing, you need to seriously rethink your life, because you're putting too much at risk. You're going to, you're going to fail the sleep test, because when markets are doing badly, you're going to be unable to sleep, because there's your closest attachment right there.
Professor Damodaran, it's been a pleasure. Thank you so much for joining me today.
Thank you for having me.
Take a moment to please subscribe to the channel and like this video. We really appreciate your participation.